Thank you so much for joining us today on the Saturday. My name is Sudarshan, and I will be taking you through today's webinar. The past month has been influenced largely by political tensions. We've had political tensions between the United States and North Korea, between China and India, and the Gulf Cooperation Council and Qatar, and also the European Union and the United Kingdom. A lot of these are having influence on the everyday finances of people. We will be having a look at how these are having an effect on you in today's webinar. First, let's begin with the EU and the United Kingdom. The inflation is the primary parameter that is used to determine the interest rates in an economy. Most of the developed economies have picked their inflation target at 2%. Very few are able to manage to achieve it. The United Kingdom, for example, has achieved 2.6% of inflation, but there is also a risk that this inflation might be because of excessively depreciation of the British currency. Now, because of the very low cost of British currency in the international markets, Britain, which largely imports its goods, will find it a lot more expensive to buy for itself. This, in turn, will be driving the inflation in the UK. The European Union, on the other hand, has been performing quite well. If you look at the economic indicators, as measured by the PMI, the Composite Manufacturing Services PMI, all of them are largely positive, and positive by a very big margin, that too. The composite PMI at 55.7 is lower than 56.3, which it achieved in June. But still, that much of an inflation, that much of a PMI suggests rapid expansion in economic activity. That said, the unemployment rate of the European Union is 7.7%, which is a low since 2009. But the inflation for the EU is still 1.4%, and the European Central Bank would like to keep it at 2%. Because of this, we will not see the European Central Bank tapering its quantitative easing immediately. However, they have considered tapering it off over the next year. The EU and the UK were split. The UK was supposed to split from the European Union in the beginning of May. Now, with UK favoring a much stronger or harder exit from the European Union, Prime Minister Theresa May had called for a snap elections in last month. However, the results were not quite favorable. And now the United Kingdom's ruling party is split three ways on the Brexit. One group favors a hard exit from the European Union, meaning they want an immediate and a quick exit from the European Union. The second wants a gradual exit because they understand the ramifications of a quick exit from the European Union. And the third group, which includes the Prime Minister, is opting for a more pragmatic approach, wherein the primary objective is to exit the European Union, but at the same time avoiding a cliff edge. In terms of economic growth, the EU has grown at 0.6% in terms of GDP in the last quarter. The United Kingdom grew at 0.3% in the same quarter. Although this suggests that there is economic activity picking up in Britain, there are risks that it will be heading towards a recession. Moving on to the economy of Japan. The Japanese economy primarily is facing with a different type of a problem. The Japanese yen is considered a safe haven, similar to the US dollar and gold. Recent political developments have increased the value of yen in the market. Yen has become one of the most preferred currencies for investment currently. But in terms of economic activity, Japan's PMI in composite manufacturing services have all recorded positive. But like the European Union, they too have seen a drop in July compared to June. The unemployment rate for Japan was 2.8% for the month of July. And this continues to be a low since the 1990s. And core inflation, one of the most critical measurements for the Japanese economy as such, is positive. Now, Japan had experienced massive growth through the 60s till the 90s. And in the mid-90s, it had, and since the mid-90s, it's experienced chronic deflation. Consequently, the Japanese economy has not managed to grow significantly since then. With the core inflation coming positive for the 5th consecutive month, this is a very positive indication that the economic policies taken up by the Japanese government and the Bank of Japan are yielding. However, a core inflation of 0.4% is still a far cry from the 2% that the Bank of Japan would like to have it from. Consequently, the Bank of Japan has lowered the forecast for the inflation in the coming year. It has, however, increased expectations of how much the GDP will rise in the coming year. And because of this, the Bank of Japan has kept the monetary policy steady. The Q2 GDP growth for Japan stood at 0.3%. And considering how Japan's experienced deflation and a stagnation of economic growth, a 0.3% is very much a welcome sign. Moving on to the economy of the United States. US economy continues to perform well in terms of economic activity. The composite, the manufacturing services PMI have all outpaced and have grown much faster than what how they grew in the month of June compared to July. Unemployment rate continues to be low, wage growth continues to be low, and jobs added continues to be high. In the last Federal Reserve's policy review, the Federal Reserve has kept the policy rates unchanged. Why? Primarily because there are other indicators that suggest that the US economy may not be performing very well. Looking at the Q2 GDP growth of the United States, it stood at 2.6%. Economic activity in measured by PMI, all are in positive. Wage growth is positive. Unemployment rate is a low since before since the 2000s, and jobs added are being added at 209,000 for the month of July, is also quite robust. But the Federal Reserve also considers one more factor, which is inflation. The inflation for the United States for the month of July stood at 1.7%. That's a retail inflation. And the wholesale price index surprisingly fell by 0.1%, which means that the United States also is not experiencing positive inflation. The United States additionally is also embroiled in a geopolitical tension, which could potentially affect its third quarter GDP. This is primarily with the North Korea. On August 9th, when President Trump had suggested aggressive action against North Korea, the US dollar index fell, US indices fell, and investors moved their money to much more safer havens, like in the previously discussed Japan and gold. And the Federal Reserve itself believes that such aggressive talk could derail America's GDP growth in this current quarter. Much closer to North Korea, Asia Pacific region, the growth is primarily driven by China. The Q2 GDP of China has grown at 6.9%. This is much better than expected. However, this growth has primarily been fueled by debt. The composite PMI of China reads 51.9 for the month of July, which is much better than the 51.1 for the month of June. However, this continues to be fueled by debt, and the forecast for although the forecast for the Chinese GDP growth for this month has been raised, the long-term forecast for the Chinese GDP growth has been lowered. In the previous month, the manufacturing PMI of China had fallen to 50.4 from 51 in the month of May. This has a spillover effect on the Asian economies, the Southeast Asian economies, primarily because the Southeast Asian economies have a large dependency on China. Consequently, due to this fall of 51 to 50.4 in the month of June, the Southeast Asian economies also experienced a fall in PMI in terms of manufacturing, which is why we can see that although the PMI for manufacturing in June was 50.0, indicating neither growth nor a drop, but in July it fell to 49.3, indicating a lowering in terms of the economic activity in manufacturing. Now, because of the political tensions between China and North Korea, the dollar value slipped. Consequently, China's yuan grew against the dollar. China is in the process of looking at de-risking its debt-fueled economy. The Chinese bank has extended its deadline by 2 months to most of its retail banks to submit risk assessments. Considering this, it means that the Chinese economy is addressing the risk in terms of debt-fueled GDP growth. Across the world, if you look at Latin American economies, the Latin American economies are primarily commodity driven, and their biggest trading partner is China. In the previous month, we saw the Chinese PMI declining in manufacturing compared to the month of May. And that in turn has a ripple effect on the Latin American economies as well, which is why we can see that the PMI of Brazil, which just got out of a recession, is back in the red. A PMI indicator of 50 and over 50 suggests expansion in economic activity, but a PMI reading of less than 50 suggests a decline or a contract in economic activity. In the first quarter of 2017, Brazil's economy expanded by 1%. And the GDP of Brazil is forecasted to grow by about 0.4% for this coming year. The whole of Latin America is expected to grow by 1.1% in terms of GDP for the current year. But however, the growth of Latin American economies depends a lot on its commodity exports. Primarily, it depends on how the economy of China performs. With the GDP of China picking up in the previous quarter, you can expect the Latin American economies to also show a bit of growth in terms of economic activity and GDP. In Latin America as well, there are a lot of political tensions that are leading to its low growth. Although most of the region is expected to grow, there are countries such as Venezuela which are experiencing political tensions, and they are expected to contract by 7.8% in terms of GDP terms in this year. But the region as a whole is slowly moving out of its politically fueled economic maladies. So we will have the Latin American economies gradually getting out of their slow growth until, of course, some other political uncertainty crops up. Moving on to commodities, specifically oil. This is another commodity that is influenced largely by political uncertainties. OPEC was formed in the 1960s to counter as a sort of a collaboration between oil producers to control the prices of oil. Over the past year, OPEC had meetings where they had discussed to reduce the production of oil. And in November, when they struck a deal and also have brought on board Russia, oil prices, which were lingering around $25, rallied all the way up to about $45. Although this was welcome for the oil market, the demand for oil, however, has still not yet picked up, and there continues to be higher production of oil compared to the consumption of oil. We had US oil inventories, which were continuing to rise to new levels, which kept the oil prices subdued. And with rising oil prices, we also have production of shale oil from the United States and Canada. All of these limited the upside of how much the oil prices could rally to. Recently, with the rift between the Gulf Cooperative Council and Qatar, there was a bit of volatility in the oil market. However, there was this volatility was not sustained in the positive side. Oil price continued to be range bound. Over last month, Russia has considered raising its production of oil to boost its own economic growth. This further will reduce the upside up to which oil prices can rally. Oil prices had recently hit just breached the $50 mark. On 31st July, they had breached the $50.17 mark, as measured by the WTI. However, they have not been able to sustain the $50 range since then. And with the expected increase in oil output, there may not be much of an upside, and there are fewer chances for oil prices to rally beyond the $50 per barrel mark. Political tensions always help the case of gold. With North Korea and USA, India and China, UK and the European Union, Gulf Cooperative Council and Qatar, there are so many cases where the political tensions might potentially harm the growth of economic activity across the world. In such a case, there are two commodities. There is one commodity that investors primarily invest in, which is gold. The other being the Japanese yen, as we had discussed in the previous section in Japan. Now, with the rising tensions across the world, you can clearly see that since early July till date, gold has been continuing to rise. As of yesterday evening, gold prices reached a high of about $1,288 per troy ounce. And we expect that the gold prices may continue to rise unless de-escalation measures are taken across the world. Additionally, with the US Federal Reserve not raising its interest rates, dollar had weakened, and with the weakening of dollar, the price of gold also increases. Looking at all of this, we look at how the Indian economy will be performing. Last month, the inflation, as measured by CPI, was 1.54%, which is less than the 2% mark that the RBI has kept as a lower bound. The WPI measure of inflation stood at a very low 0.9%. For most of July, economic activity did not grow. In fact, it shrank. Primary reason being the introduction of the GST, Because of the GST, there was uncertainty in terms of orders. However, this is expected to be only a one-time event. This is not expected to be there is no long-term negative effect of GST. However, there are more positive effects of GST in the longer term. However, with the introduction of GST, economic activity did shrink, not just in manufacturing, but services as well. The overall composite PMI of manufacturing, services, and overall economic activity stood at 46.0, which is a low. Manufacturing PMI is at a 8-year low. Beg your pardon. Services PMI is at a 4-year low. All of these suggest that India is only going through a transition in its growth. The introduction of GST will have long-term positive effects, but in the immediate term, there will always be a bit of troubles in terms of making the change. Now, because of the low inflation as measured by the CPI and WPI, the RBI was largely expected to reduce its interest rates. The RBI did reduce its interest rates by 25 basis points. So the current repo rate, as maintained by RBI, has been reduced from 6.25% to 6%. The monsoons, which are the primary source of water for an agricultural dependent India, as of 1st August stood at 1% excess. However, the distribution of monsoon has been a bit erratic. Why it matters is that because of the erratic monsoon, we have seen the prices of vegetables grow up. And because of growing prices of vegetables, we will also see the inflation assets go up. This inflation will further be fueled by global factors as well. Fuel prices are likely to increase, as we had discussed under the oil section. Gold prices will rally because the price of gold itself is rallying in the world market. Importing of goods might become cheaper. However, with tensions with China, we do expect a few economic activities, politically motivated ones, which may reduce our dependency on Chinese exports marginally. So all of these will mean that inflation in India will inch upwards probably in the coming months. Moving on to how we arrive at an investment strategy. Over the past week or so, the equity markets have been crashing, primarily because of political reasons. We have had the US North Korea relations and with the Asian economies, PMI results all suggesting general weakness in the Asian economies as such. We have seen an outflow of capital. So we have also seen the PMI numbers of India for the month of July, suggesting a weakness in economic growth. All of these indicate that all of these suggest created a case for the equity markets to correct briefly. However, the introduction of GST is good. And over the longer term, we can actually expect the Indian economy to regain its robust growth, which was seen in the 2000s and the most of last year. All of these will lead equity markets to rally over the medium term to long term. In the immediate term, however, we will expect volatility to continue. In such a scenario, it is best to hold equities for the longer duration. And to tide over the volatility in the immediate term, it is best to invest in the form of a systematic investment plan. With the lowering of the interest rates by the RBI, bonds of longer duration become much more attractive. So we will actually see a rally in the bond market each time the RBI lowers interest rate. And also with the introduction of the GST, the government has realized growth in terms of realized revenue in the form of taxes. There have been an increased number of taxpayers because of the GST. Currently, the tax to GDP ratio is about 11.9% for India, which is not particularly sustainable. But with the introduction of GST, the government's finances are expected to become much better. All of these suggest that bonds of longer duration will become more and more attractive. So holding bonds in the portfolio will be beneficial for two purposes. One, they will be able to tide over the volatility caused by the equities. And two, they will give returns over the longer duration as well. So it's best to hold bonds of longer duration in the portfolio. A lot of the uncertainty in the world is fueled by geopolitical causes. So all of these, in such a scenario, will cause gold to become more and more attractive. Over the past 1 month or so, we've seen gold rally from somewhere around $1,200 to about $1,290 per troy ounce. Gold, although is rallying now, is not an investment that will give. It's not an investment for returns. Gold is an investment primarily only for hedging. So those who had invested in gold about 1 month ago, along with equity, will have the benefits of both the rallying gold as well as the equity market, which are rallied for about 3 weeks. All of these will lead for an investor to minimize the losses in his portfolio. So it's best to hold gold as a hedge with not more than 5 to 10% exposure to gold in the portfolio. With this, we reach the end of our webinar. Thank you so much for your participation. We are now open to questions. We have a question. Will the Sensex fall below the 30,000 mark? We expect volatility in the immediate term. So the Sensex falling below 30,000 is a possibility. More question. Should we remove mutual funds or wait for the market to come back? The way we recommend a portfolio is a mixture of equity, debt, and gold. Please talk to your financial advisor for the recommended portfolio of your investment horizon and risk type. Primarily, how we suggest building a portfolio is to keep it for the longer duration. So even though there may be volatility in the immediate term, over the long term, staying invested is more beneficial. So even though you may experience losses in terms of the equity investments, you will have a rally in terms of your debt investments. And additionally, if you have invested in gold, they will also prove to be your hedge. When maintaining such a portfolio, it is best to stay invested and stay as a passive investor rather than an active investor who trades on mutual funds, because there is no right time per se to invest in a market. Any time is a good time because you have to be an investor rather than a trader. We have another question. I think is it the right time to invest in mutual fund? The earlier you start investing in any sorts is beneficial. Mutual funds of debt types are going to rally. Longer duration debt types are going to rally. Equity mutual funds might be in correction phase, but because of the correction, you have the ability to invest in mutual fund at a much lower rate. So yes, it is a good time to start investing in mutual funds. We have another question. Are the interest rates going to go down further, and will it have an effect on the debt mutual funds? Currently, the inflation factors look to be on the upside. So we expect the inflation back to within the 2 to 6% range that the RBI would like to have it to. Now, RBI also expects inflation to pick up even though it's lowered the forecast in the coming quarters, primarily due to global factors. These in turn will suggest the RBI may not lower interest rates immediately. However, we could wait for another quarter or so to see how the political situations would have altered the situation. But in the immediate term, we don't see interest rates going down further. And so we will have, with the lowering of the interest rates in the just about last week ago, we will see longer duration funds rallying, but the shorter duration funds will become will underperform a little bit. We have a question regarding debt mutual funds. Customer holds a short-term mutual fund with YTM of 8.66, but only 1 year, and another dynamic with about 7.6 with 4 years duration. Which is a better option? Well, it depends on how you would want to design a portfolio primarily. If you are looking for stable and long-term growth, whereas if it would be better for you to have a longer duration, which is the 4-year one. We would suggest you talk to your financial planner regarding how you should allocate your portfolio for this purpose. Are there any more questions? We have one more question regarding what do you mean by exposure of gold up to 5 to 10%? Let us say that you are investing in an SIP, for example. Let's say you invest in about 50% in equity and 45% in debt. The remaining 5% should be invested in gold. That is what we mean by exposure of about 5 to 10% in gold. We have a question regarding SEBI's recent crackdown on the shell companies and how mutual funds are affected. Right. So SEBI had shortlisted about 331 companies suspected of being shell companies. There is no confirmation per se that all 331 are shell companies. There is a possibility that they are, and some of them are legitimate as well. Now, with regards to how they affect the mutual funds, the 331 listed companies primarily operate in the small cap and micro cap space. And funds which invest in the small cap and micro cap space would, if they have an exposure to these mutual funds, would have seen a bit of a correction. At this point, we would also like to tell our customers who have invested with us that the mutual funds which we have recommended have been searched thoroughly with also their holdings, and we would like to inform you that the mutual funds which we recommend do not have any of the 331 listed companies in their holdings. Do we have any more questions? Thank you so much for your participation in the webinar today. Thank you so much for the questions as well. We look forward to seeing you in our next webinar.